When we talk about major disruption on this deep dive, it usually comes with a huge public fanfare, IPOs, viral product launches, things like that.
Right, a lot of noise.
But today, we're looking at something much quieter, but I think far more foundational. 5 interconnected forces that are shifting from just concepts to, well, commercial realities.
And these aren't just small updates. The analysis suggests these forces are poised to collectively unlock trillions in new value over the next decade.
Trillions.
Yeah, because they're addressing the deepest structural problems in our global economy. Everything from how we do knowledge work to how we power our cities.
So our mission today is to cut through that complexity. We're going to dig into what these 5 forces are, why they matter, and most importantly, the specific signals that investors are watching right now.
We're talking AI agents, the energy storage revolution, small modular reactors, tokenized real estate, and something often overlooked, water infrastructure.
Welcome to everything you need to know about finance.
And just before we get into it, a quick disclaimer. We're here to break down the information and analysis we've reviewed. This is a deep dive into data and trends. It's not financial advice.
Exactly. Our goal is to get you up to speed, fast. And by the way, your feedback really helps shape these deep dives, so if you find this kind of content interesting, please do like and subscribe.
Okay, so to set the stage, I think the most fascinating thing from the recent reports is the timeline. We've had technologies like AI and battery tech for years.
Right, they're not new ideas.
No, but the key shift that's happening right now is the jump from small pilot projects to actual commercial scaling. That's the acceleration curve that drives this exponential growth into the 2030s.
Okay, let's start with the one that feels most immediate then. Agentic AI. We should probably define this because it's a huge leap beyond the chatbots everyone's used to.
It really is. This is the automation layer. We're moving past an AI that just answers a question and into the realm of, well, an autonomous digital worker.
So how do I distinguish between just a complex AI and an agentic AI system? What's the real difference?
The difference is all about autonomy and action. A standard large language model, it reacts. You give it a prompt, it generates text. That's it.
Okay.
An agentic AI system executes. It can set its own goals, plan a multi-step sequence to achieve that goal, and then chain together different tools to get it done. It even self-corrects.
So it's not just running an email for me. It's researching a client, finding their contact info, drafting a personalized email, and then scheduling a follow-up in my calendar all on its own.
Exactly. And this completely changes the economics of software. The analysis points out that this productivity boost shifts value away from those giant all-in-one applications.
So value moves to smaller, more specialized, software's agent businesses?
Precisely. It's like replumbing the digital backbone of how companies work.
And the growth projections are pretty stunning. Some reports project these high double-digit compound annual growth rates, QAGRs, into the 2030s. What does that actually mean in practice?
It means the market is expected to double or maybe even triple every few years. It's a classic exponential curve. The acceleration is the signal.
So for an investor, what are the signals to watch?
You look for a few things. First, the big cloud vendors, Microsoft, Google, Amazon. You watch them build out their agent platforms. Second, you look at enterprise adoption metrics. Are companies moving past small tests and into, say, full-scale sales automation or customer service?
Okay, but you mentioned autonomous action. That sounds risky. I mean, if an AI agent makes a bad trade or violates a rule, who's liable?
That is the single biggest hurdle. It's a huge regulatory and ethical question. On top of that, you still have the technical risk of models, hallucinated, just making things up.
So the regulatory gray area is the real ceiling on adoption right now.
It's the biggest roadblock to moving these agents out of test labs and into mission-critical roles, for sure.
All right, let's shift from the digital layer to the physical. Force number 2, the energy storage revolution. For years, this conversation was all about lithium-ion. But that's changing fast, right?
It's a critical shift. We're moving away from a one-size-fits-all battery. The innovation now is happening across solid-state batteries, sodium-ion, flow batteries, even things like thermal and hydrogen storage.
Why so many different types? Why can't one battery just do it all?
Because they solve different problems.
Yeah.
Lithium-ion is great for EVs, where you need a lot of energy in a small space. But for the grid, you need something that's incredibly safe and can store power for a very long time.
Right, not just for a few hours.
Exactly. Days or even seasons. That's where things like thermal storage using molten salt or hydrogen come in. They're essential for making intermittent renewables like wind and solar truly reliable, what we call firm power.
So this is about more than just a better EV. This is about actually making the grid work without fossil fuels. The numbers are still wild, though. Some projections for solid-state batteries, for instance, show them growing into a multi-billion-dollar market by 2030.
Yeah, the growth is explosive. So when tracking this, you look for tangible signals. Pilot announcements from major automakers are a big one. That proves they can actually be manufactured at scale.
What else?
You also track grid-scale contracts, who's signing the big deals. And maybe most importantly, watch for M&A activity among the suppliers of critical metals, nickel, cobalt, lithium. That tells you companies are scrambling to secure their supply chains for the long haul.
So the biggest risks here are really about manufacturing and materials, then.
Absolutely. Taking a new battery chemistry from a lab bench to a gigafactory is incredibly hard. You've got material science hurdles, huge capital costs, and massive bottlenecks for minerals where demand is set to just skyrocket.
And that problem of firm, reliable power.
Well, it leads us directly to our third force, small modular reactors, or SMRs.
Exactly. Because even the best battery can't provide that 247 base load power that heavy industry needs. SMRs are the next great hope for low-carbon, firm power.
Think of them as factory-built nuclear reactors. That's the key. They're much smaller than the huge custom-built plants of the past. The modular factory-built approach completely changes the risk profile.
How so?
Instead of a utility betting, say, $20 billion on a single giant project that takes 15 years, SMRs allow for smaller, standardized deployments. It lowers the upfront capital, and they can be placed much more flexibly, closer to where the power is needed.
And these are actually moving from concept to reality now.
They are. Reports confirm SMRs are moving into first-of-a-kind commercial projects around the world. The transition is happening.
So from a market perspective, how do we track this? Because nuclear is so tied up in government approval.
You have to focus on the regulatory choke points. The key signals are government funding and, most importantly, licensing timelines. You need to see regulators setting clear, repeatable paths for approval. And then look for the offtake contracts.
Offtake.
Yeah, contracts with big industrial customers like data centers. That validates the commercial demand for the power from these first SMRs.
And the risks? Is it just public perception?
That's part of it. But the biggest headache for the companies building them is cost management on these first few fleets. The idea is mass production, but the first units almost always have cost overruns while they iron out the kinks. That's the highest hurdle.
Okay, so let's make a big shift now. We've talked about energy, the physical engine of the economy. Now let's talk about capital. Force number 4, tokenized real estate.
Right. This is about reshaping the actual plumbing of capital markets using blockchain technology.
What does that mean in simple terms?
It means issuing digital tokens on a blockchain that represent fractional ownership of a real-world asset. Think of a piece of skyscraper or a stake in a private company.
But wait, we have things like REITs for fractional ownership of real estate already? What's so revolutionary here?
The revolution is in liquidity and accessibility. I mean, think about a $100 million office building. To buy a piece of that today, you have to be a huge institution, and selling it can take months of legal paperwork.
It's notoriously illiquid.
Exactly. Tokenization lets you break that building down into, say, 1 million tradable digital tokens. Suddenly, a small investor can buy $100 worth of that building and trade it instantly, 247. It makes the world's most illiquid assets accessible and tradable.
And the potential scale of this is just massive. Some analysts are projecting something like $4 trillion in tokenized real estate by 2035.
That's why it's a foundational force. For investors, the signals here are all about institutional action and regulation. You have to watch for regulatory clarity in the big markets, the US, the EU. Until the rules are clear, big money won't move in at scale.
So the biggest risk is just legal uncertainty.
Absolutely. The primary hurdle is making sure these tokens comply with existing securities laws. How is custody handled? How do you ensure a liquid secondary market? Those are the big questions that need answers before we get to that $4 trillion figure.
Okay, our fifth and final force. This one brings us back to the physical world, driven not by some new tech, but by sheer necessity. The global water crisis.
It's easy to focus on AI and shiny new tech. But this is a long-duration structural demand that simply cannot be ignored.
What do the numbers say?
The reports are stark. Roughly half the world's population faces severe water scarcity for at least part of the year. Add to that aging infrastructure in developed countries and climate change, making droughts and floods worse.
It's not just an environmental problem then, it quickly becomes an economic one.
A huge one. Water shortages disrupt everything: agriculture, manufacturing, energy. So that triggers massive long-term spending on resilience.
And this isn't just about pipes and pumps.
No, not at all. We're talking about a huge wave of capital into advanced water treatment, sensor networks to detect leaks, predictive AI modeling, and big infrastructure like desalination and water recycling plants.
So how do you track an investment theme that's so broad?
You look at it in layers. First, track big government infrastructure spending packages. Second, watch for M&A in specialized water tech companies. And third, you have to analyze regional risk maps. Capital is flowing to places where scarcity is high and the regulatory environment is stable enough to get a predictable return.
And the risk profile here is completely different from an AI startup.
Entirely. The risks are mainly political and regulatory. Water is a highly political resource. And municipal projects. They have incredibly long timelines, so technology adoption can be very slow.
Wow. Okay, so 5 massive forces. We covered AI agents automating knowledge work, advanced energy making the grid stable, tokenization unlocking capital, and now water infrastructure.
And if you connect the dots, what you see is the global economy trying to solve its biggest structural problems all at once. It's not one disruption, it's a series of interlocking solutions.
That's a great way to put it.
We're creating a new class of digital labor with AI, then building the firm power needed to run that digital economy with new energy tech, then finding better ways to fund it all with tokenization, and finally securing the essential resources everything depends on.
So the analysis suggests the real growth, the trillions in new value, won't come from these early pilot projects. It's going to come when these things really scale up across the board.
Exactly. That scaled future is the key investment landscape of the next decade.
Which brings us to our final provocative thought for you to explore. These 5 forces, they don't exist in a vacuum, do they?
Not at all. They feed into each other. So think about this. If SMRs successfully stabilize power grids and provide tons of cheap, reliable power, how does that accelerate the adoption of energy-hungry AI agents? What are the second-order connections between these 5 forces? Because those connections will truly define the next decade.
Something to mull over. Thank you for diving deep with us today. If you enjoyed this focused look at complex topics shaping our financial future, please try out our latest episodes for more deep dives into the trends that are reshaping our world.